Good afternoon. I'm happy to be here, and after two outstanding speakers. Normally, it's a very tough job to listen to economists after lunch. So I hope my predecessors have done a very good job to keep you awake. My job is to send you to half a sleep so that when we come to the Q&A section, then there will be no tough questions. Outlook for next year is not too difficult to predict. I have a word saying what is next year's like. It is a year of certain uncertainty, which means that the only thing you are certain that next year is you don't know what is going to happen. Just like 2 days ago, nobody predicted that the central bank in China will cut reserve ratio. We believe that they will cut before the year end, but we don't expect them to cut that quick. In fact, this time, the Chinese have almost steal the show by moving just a few hours ahead of the other major central banks in the world when they cut down the interest rate charged for the swap line and a few other measures. There's a lot of uncertainty in the world. What we could be certain is growth will be slow. That is not our prediction. That's what history already. Ever since the economy picked up in early this year, everybody is slowing one way or another. Too much focus is on America, Europe, and China. But if you look at ASEAN, the Southeast Asian countries, India, the second giant in Asia, they're all in the same trend. The reason is simple. We have gone through a reshaped recovery since 2009, 2010. Either because we rebound too quickly, that there are bottlenecks in the supply side, particularly in the infrastructure, or because the easy part of the work is done. You have high growth because you have low base. 2009, everybody is negative or slow growth. So come to 2010, you easily have higher growth. But once you go into 2011, when growth last year is normal or super high, then things will have to slow down. That is one part of it. It's more statistical or data-driven. The bigger part of it actually is in the region, we have overdone ourselves in our recovery. We ease too much, we drive too much. Suddenly we find that we have to slow down a little bit. Otherwise, inflation is too high. In China, people feel about that. Hong Kong, we feel about that. It's not just the general consumer price, but also asset price. My argument is always in Hong Kong, we love inflation. Love inflation in two meanings. One is that compared with deflation, it is a better way to enjoy life. Particularly when your wage inflation can run ahead of the price inflation. But more important is that Hong Kong is a more affluent economy, where many people have some sort of asset, either in terms of deposits, or better in terms of stocks, or more in terms of property. When it comes to inflation, your asset price rise, just like what you saw in the stock market today, you should be happy. But for the broader public in Asia, where many of those are still farmers in the countryside, that's not a good thing. Too high inflation, as you can see in China, in India, in Indonesia, cause troubles. So central banks in the region has been tightening for more than a year now. So growth needs to slow, and it's slowing. What we see in the chart here is that individually, Indonesia, Malaysia, actually Thailand included, Singapore, if you look at the last 1 to 2 quarters, the growth actually rebounds or stabilizes. It's somewhere between 3.5% to 6.5% growth, which we say that is more normal. So the way we see things going on is that even though it's slowing down from last year's high growth, it is a normalization process, and that should continue for the next 2 to 3 quarters. The same happens in Philippines, Vietnam, India, we have the third quarter GDP growth yesterday, which is 6.9%, which is lower than the previous quarters, but the highest in South and Southeast Asia. So the first thing we look at is that we are in a moderation growth process. It will continue for at least 1 to 2 more quarters, but chances it is a soft landing. There's no hard landing. So if you run into people who think that it's a hard landing, is they are running away, trying to sell everything in their hand, you can pick something cheap. Behind the growth, there are two drivers, one external, one is domestic. Much of the growth in this region, in Southeast Asia, Northeast Asia, as well as South Asia, in this latest round of growth is more domestic driven, which is not exactly correct. Domestic, not just in terms of the local consumption, local investment, but also the regional consumption and regional investment. In Hong Kong, you can feel it. You go to the shops, you go to the restaurants, it's full and flooded, not just by the local consumers, but also by our friends from the mainland and from other places around Asia. So regional demand has been strong, partly because we are not hit as badly as the West. Some people say that we learned our lesson in the last crisis back in 97, 98. So we are smarter. Also, we are not as developed as the Americans and the Europeans who have all those high-engineered financial tools to leverage themselves up and now deleverage themselves down. We are normal people. We do normal business. So when the crisis comes, we slow down a little bit, and then we recover faster. This domestic demand will continue to drive growth in the region. What is critical here is to make sure that confidence stays. I think that should more or less be the case. We can't think of anything dramatic that will drive down our confidence in the region. Of course, people are concerned about the US, people are concerned about Europe, and some people are also concerned about China. But it's very unlikely you'll see something as horrible as back in 97, 98, or back in 2008, 2009. Some people say that Europe can be a Lehman 2.0, or version number 2. My take is that you won't get it. The Europeans actually is fiscally stronger than America, stronger than the British, and stronger than the Japanese. They have money to tie themselves out. Their own problem is that those who have money in the pocket, the Germans, the French, doesn't want to spend their money with the poor, the Greeks, and maybe the Italians. The beauty about the whole European crisis is that everybody is on the same boat, and they understand that. There's no way you can sink a boat but keep yourself afloat. It's a matter of negotiation, bargaining. How much the Greeks, the Irish, is willing to pay or promise to get the money from the rich. This process could drag easily 2-3 years, and you will have all the horror story to live with. But the bottom line is that the ship won't sink. One historian in America who claimed that he has the foresight to predict this latest crisis have written recently about Euro. 2022, 10 or 12, 11 years later, when he will visit Europe again, he's surprised that the Euro is still there and actually gets stronger. What makes the difference that time is that some of the Euro members will not be there, but it was added by some stronger Euro members. The Eurozone by then would be sounds like a Deutschmark because it's more a German zone rather than a Eurozone. And the United Kingdom will be named as the United Kingdom because Ireland, which suffers so much, cannot stand the Germans, will leave Eurozone and join the British, so become a the United Kingdom. This is an interesting analysis. If you have interest, you can search Google. The writer's name is Neil Ferguson. He's the professor of history in Harvard. But what I want to take is, I share the vision, Euro will stay. Some of the members will be different. And this roller coaster we are riding will not take you down anything below what you have seen in the layman time. That is good news for our region, because on the right-hand side you see that the correlation or the relationship of growth in Asia from Hong Kong, HK, MY, Malaysia, TH, Thailand, all the way down to ID, which is Indonesia, are highly correlated to the growth in Europe and the US. So if anything goes wrong in Europe, don't think that you can be spared. We expect Europe to go into recession in the next 1 to 2 quarters. Some of our Asian countries, including Hong Kong actually, could technically be in recession. Some of the ASEAN countries, like Singapore, could tell you that they are not in recession yet. Only in a year later, when they revise and revise and revise the number to final, they will admit that we were actually in technical recession. That is where we are now. In terms of quarter-and-quarter growth, the output we have now versus the previous quarter or the quarter ahead will be lower. Things will slow. But this is a very shallow recession, because if you look at the chart on the left, simply on export, who drives our export today? EU and US on the top of the bars hardly account for 1/5 of the export growth in Asia, including India, Indonesia, China, Hong Kong, Thailand, Singapore, Philippines, Malaysia. So Europe are still important in different ways, but at least not in the way they trade. Someone tried to assess how big an impact if the Eurozone get into trouble. In terms of trade, as I just mentioned, they don't contribute too much. Greece is almost non-existent in our trade picture in Asia. Seldom in Asia trade with Greece in anything more than 1% of our trade, either import or export. If you take Greece, Portugal, Ireland, Spain, and Italy together, they may be slightly bigger, account for 5% or so of Asia's trade. If you take the whole EU, which is 27 members, including Britain, that is significant. It's somewhere between 10 to 20% of Asia's export. But we are not looking at the whole EU in recession, and even if they were in recession, we don't think that trade will be totally stopped. So at best or at worst, you may lose 1.5 percentage point of your growth. What is more important and what you may feel more directly is the financial market, just like what you saw today. Today the market is almost up 1,000 points. Yesterday, Europe, US equity market up 4 to 5%. The world suddenly seems more lovely. That is because the financial linkages between Asia and Europe, Asia and US, is still very strong. If you look at the top right chart, my apology for the small print, you just look at the line on the top, European banks. Put it simply, that line shows you how much European banks, by classification including our bank, because our headquarters is in UK, how much today lend to this part of the world, Asia. It's about 1.2 trillion US dollar. It's hard to put it in size. Hong Kong's economy is about 250 billion US dollar. So it's almost 5 times of Hong Kong's GDP. But what is more interesting is that you look the 2 lines below, US banks and Japanese banks. European banks lending in Asia is twice the total of US and Japanese banks together. So imagine if the Eurozone get in trouble, European banks get in trouble, and they have to withdraw lending. and to cut the line, then how much damage they can do to the region. The next three other charts just tells you what have seen during the Lehman period, how much they were down, how much they account for our total banking assets. I can only tell you that Hong Kong is phenomenally important. But you should be happy. This importance of European bank in Hong Kong is primarily because of two banks, our bank and the bank next door. These two take up more than half of the so-called European bank exposure in Hong Kong. And I can assure you, we're here for good. We won't cut your eye. But I can't promise for the other banks. So if you think that there will be something bad coming, try to find the right place to sit. This initial impact will be more on the financial area. Also could be on the equity stock market, because Europeans account for 15 to 30% of the market activities in our market in Asia. So all this tells you that the worst you should prepare yourself is, in the financial side, stay in the right place. Try to be prepared that there will be some stress from the banking system. Assume that stress really comes. How capable are we to recover and withstand that? Again, this chart helps you to understand. On the vertical axis, it tells you how much the Asian governments have borrowed. The more debt you have, the less capable are you to spend, because you already overspent yourself or spent too much before. I can only tell you that this chart is somewhat distorted by one member, SG, Singapore. Singapore have close to 100% debt. That is true, but not too true. True in the sense that these are truly government borrowings, mainly from their own people. But why do they borrow? It's because they take hold of people's pension, or in our sense here is MPF. Every Singaporean have to put 20 to 40% of the salary into a pension fund, which need to be managed, or have to be managed by the Singapore government. By doing so, it means that the Singapore government actually borrowed that money from the Singapore people. So that's why these are the debt for the government. But assume that money is safe, the government doesn't really need money to run the government. So actually, Singapore is probably as low as what you see in Hong Kong, almost low debt. The other one is India, which have relatively higher debt, somewhere around 70% of GDP. Put you back in perspective, we don't know how much a government can borrow before they run into stress. In Europe now, we heard that some governments are in distress because they borrow more than 100% of the GDP. Greece is 160% or 170%. Italy is 120 to 130%. So anyone above 100% borrowing could be identified as bad borrowers. But we have Japan. The government there borrowed 200% of GDP, and nobody paid a damn to it. You are still happy, including the Chinese government, try to rush to buy JGB, the Japan government bond. So it really varies between places. It's particularly scary for a government who borrow big and borrow abroad. If they borrow from domestically, probably their own people have no choice. You don't want to push the government to collapse, because otherwise you can't get your money back. But if you are foreigners, the chance is that you will run first. You try to get your money first, and the government could be in trouble. So overall, if you use the European standard where government borrows 100 to 150% and in trouble, all the Asian countries are in relatively good terms, and we expect them, when things slow, they will stimulate. One more point is about Hong Kong here. ASEAN and India, if you have to make a choice which place to go, I'm not recommending any particular countries, but just simply look at the trade picture of the last several years. Consistently, our trade, either import or export, with India grow easily half or twice as fast as our trade with ASEAN, either in import and export. So that probably tells you that either there's still a lot of potential you can explore in India, or you can say that ASEAN countries are good traders. We've been trading all along, but of course, growth potential will be less. Next year will be interesting also. I say that it is a year of certain uncertainty. One uncertainty we say that is we need is political uncertainty. We don't know which chief executive we will have next year. We don't know which president Taiwan will have. We're certain that Japan will very likely have a new prime minister because they do that consecutively for the last decade, more than one prime minister in a year. There's still people guessing who will be the next prime minister in China. Korea will have the presidential election also. I just come from Mongolia, just discovered that the place also will have election next year. But the one thing that you should feel much more comfortable if you are interested in ASEAN and India is that except for Malaysia, you're almost certain which government will be running the place next year, because there's no election coming for most or all of the ASEAN economies and India also. So hopefully that helps you to make your assessment which place you should feel comfortable or less comfortable. Thank you very much.